Oh no, we're good. Go ahead.
Pretty good. It looks like it's recording right now.
Yeah, we're good.
It is. Almost got a haircut.
Yeah, brother. Come on here too. So yeah, man. Hold on. Let's chat. No, I need to participate. All right. Once again, it's on, brothers. The hope is, that all the folks that come in here week in and week out, you know what I mean? Like you get more and more knowledge every week. And then eventually go from taking the knowledge to actually doing something with it. You know what I'm saying? So I'm glad y'all came back through. Like I said, I am going to be approaching this like a class. So hopefully you did your homework, you know what I'm saying? And you did your assignment. But I want to start off, in school, we call these a launch. So I want to start off with a launch question or a do now. And so the question really goes like this, and there's no wrong answers. Would you pay $30 right now for the right to get $2 every year for the next 30 years? If so, then why?
Wait, how much per year?
$2.
Guaranteed.
You got to put up 30. You got to put up.
Yeah, so you're doubling up.
Hey, I'm with that.
It's a double, man.
You with that?
Do I get any interest on that?
For the sake of the argument, I'm going to say no. But the answer is not going to be no. But for the sake of the argument, I'll say no. So just at random, anybody have any idea why I asked that question? Go ahead, Ron.
Thinking them dividends.
Okay, tell me what you mean by that.
So basically, you had the caveat in there saying Godard said, "Do we get any interest?" So I just correlated that to if you're purchasing a stock that's not going to grow, it's just going to stay stagnant at that $30, but you get your $2 dividend per share per year. So if you just hold on to it, if you don't want to do nothing with it, you're just going to keep that $30 in, and you're going to get that $2 per year. You can keep reinvesting it back in. So eventually you're going to, get back that $30 plus sum.
All right, so Jason, you understand that?
I kind of understand it, but that wasn't the way I was thinking about the question.
Okay.
I wasn't thinking from a technical perspective. I was thinking of a psychological perspective of, am I willing to do some work now for benefit further down the line, or that I didn't have to work for.
I think that's a good way to think about it too. Ryan, did you understand that, or you got questions?
No, I understand. Yeah, I kind of agree with what Brown said.
Brad, you good with that too?
I didn't catch it, but I'm good. I'm gonna keep rolling.
Okay. So I want to give you this scenario as it relates to stocks, right? So there's different kinds of stocks. There are stocks that pay dividends, and there are stocks that don't, right? And the stocks that pay dividends, and there's a lot of them. There's a whole lot of them, right? Just because they pay dividends don't necessarily mean they're a good stock, bad stock, or whatever, right? So I wanted to introduce you guys to this concept. It's not even a concept. I want to introduce you guys to this thing called dividend aristocrats, right? And so the dividend aristocrats, in order for you to qualify, it's a qualification. So in order for you to qualify as a dividend aristocrat, you either need to have paid out dividends for at least 25 years in a row. And those dividends need to have grown annually for a minimum of 25 years. So the example that I gave you guys was actually AT&T. AT&T is one of the dividend aristocrats. And as of today, I think AT&T might be trading at like $28 and some change or something like that. But what's really interesting about it is that if you go back 5 years, AT&T was trading at about $25. Right? So in your mind, when you're thinking about investing, you're like, wait a minute. If I invested $25 5 years ago, right, and here it is today, that one share that I bought is only worth 28. I put away $25 to make $3 over a course of 5 years. And in this case, that's actually not true because AT&T is paying out a dividend of about 50 cents. It might be 51. 50 cents. We'll look at it in a second, but like 50 cents every quarter. The first quarter, 50 cents, second quarter. So over a course of a year, that's $2, right? So when Godard asked the question about am I getting interest on it, well, technically you're not.
Mm-mm.
But what's happening is if you're reinvesting those dividends, like I shared last week, you're reinvesting those dividends instead of you just having that one share, now a fractional share, 1 point something of that share, right? And so some people play the stock market by just going into dividend plays. To just say, I'm gonna dump my money. So I got two choices. I could put $30 on AT&T, or I could put $30 in the bank, in a savings account. If I put that $30 in the savings account, it's gonna be worth $30.03 5 years from now, right? If I put it in the market and buy AT&T, the reason why I'm thinking about that is because it's safe. And I know it's safe, hypothetically, because they've been paying out, because they're a dividend aristocrat, because they've been paying out a dividend for 20, well, let's look. I'm going to show you. So I'll share my screen. Hopefully I'll pay attention if anybody's popping in. I had it up, but then I pulled it down.
You got it up, it looks like.
No, I got something else up. I got a couple things up, but that's what I want to show you first. So if we're looking at this list, this computer is so buggy, it's gonna shoot me off. So we're looking at this list, and here it says here's a list of 57 stocks that are dividend aristocrats as of December 2019. So now we're looking at all these different industries, some of which you know, some of which you're familiar with, some of which you don't, right? Here's the deal. 56 straight years, consecutive years of dividend growth. 56 years of dividend growth for 3M. You guys are familiar with Aflac, I know. I didn't even know if Aflac was out for 36 years. Like that's news to me. You know what I'm saying? But here it is. They've been paying out a dividend for 36 straight years. You know, look at some of these. I want to bring your eye to something we know ain't going nowhere. Coca-Cola.
Boom.
Coca-Cola has been paying out a consistent dividend for 56 straight years.
Get in where you fit in.
And now check this out. Coca-Cola is currently trading at $45. I'm not going to make any money. Like, I don't know what Coke's going to do between now and 5 years from now, but unless they get in the Coca-Cola University or they're going to start selling beats or something like that, chances are their business model is set. And so if I'm investing in Coca-Cola, I'm not planning on making any money per se off of the stock. You understand what I mean? What I am planning on getting is that dividend every year. Colgate, right? All these things you may have heard of, ExxonMobil, you know, Hormel Foods, Johnson & Johnson. Johnson & Johnson been paying out for 56 years, right? So if you wanted to be a dividend investor, something that you might want to consider, look at Lowe's, right? Something at McDonald's. Something you might want to consider is let me do my fundamental analysis. Like, let me not just go blind and say Coke gonna be here forever. Let me go and look, right? But I feel relatively confident. Now remember, you know how many different world events has happened over the last 56 years, right? There's been all kinds of world events that have happened that have made the stock market crash over
Yep.
56 years. And the only way that you got on this list is if you continue to pay it out and you paid more year after year after year after year. So any questions about that? Any thoughts about that?
I have a question.
Yeah.
So if one of these are in, like we were talking about ETFs last week, would you still get a dividend if it's included in one of those?
All right, so that's a good question. Let's find out. So let's go here. Let's go to ETF DB, right? Oop, did I spell that right?
You got to pull up everything selects from your history, it looks like.
No, my wife's computer. She got all kind of bugs on the computer. Takes me all over the place. Like who uses Bing as a search engine?
That's a good question, yeah.
Like, really? All right. So we go to ETF. I have an answer for your question, but I want to look it up first to prove the answer.
Okay.
Shit. Move y'all faces out the way. What is the deal? All right. Have any of y'all been looking at this site at all? Okay. All right, so we're gonna look at some exposure, right? And we see, you know me, I'm gonna go to Vanguard because that's how I roll, right? So I'm gonna go to Vanguard. I'm gonna look at what's going on there. Now, the thing about it is we got VDC. VDC. So I'm actually gonna go over here real quick. VDC.
Look at that.
So now that we're here, click on dividends. All right. And so what we see here is,
Yep.
now this may not be the case for all, but what we see here is over their time. Sometimes they pay some dividends. Sometimes they go up and down and up and down and up and down, right? So right now, you're getting, 61 cents a quarter right now. A little further back, you got 74 cents a quarter, right? And that's for the whole ETF. So there are ETFs that will pay you dividends and some that don't, right?
Okay.
But now let's see, we had, what was it? 61 cents. So now remember the original question was, would you be willing to pay $30 to get two? So now the question becomes, are you willing to pay 146 to get 220 or 240?
Yep.
Yep. So are you willing to
245.
pay? Now you willing to pay? Now I can pay $30 and get two with AT&T, or I could pay 146 and get 20 more cents. See what I mean?
Mm-hmm.
Or if I'm actually going to go, if Coca-Cola is really the goal here, let me just go to Coca-Cola. And I mean, this is all when you start to like kind of weigh things out. You know what I mean? So if I press all, I'm going to see this. I mean, this is why they're aristocrat, right? Going up consistently over time, right? And so right now it's at 41 cents. So I'm paying $45 for the right to get, $1.60 annually. And I can assume that, next year that might be 42 cents based upon this current trend where they're going up a penny basically every year, right? So it's just something to think about, brothers, if you want to, you want to be investing, because what you're not going to find, what I wanted to show you guys in my stock that I wanted to talk about today was Twitter. I want to talk about Twitter. And what we'll see with Twitter when it comes to dividends.
I'm looking it up too right now.
Hey man, this
Eating Alpha.
we're going to Twitter. This is
TWTR.
and guess what? There's no information here because they don't pay a dividend. They're considered a growth stock. Like a lot of the tech stocks, what you're trying to make your money on is that Twitter is going to blow and be 200 one day.
Mm-hmm.
That's why you're not going to see a dividend with Twitter. You're not going to see a dividend with Facebook. You're not going to see a dividend with a lot of these tech companies because they're growth stocks. So where you're making your money off of them is on their stock prices, right? And so I might say, all right, I got two choices. I could spend $30 on Twitter and hope they blow, because considerably, it's possible in a year, or let's say 2 years, that Twitter could go to $60, which means I made $30 on the growth. Whereas if I bought AT&T, in order for me to get $30, that's going to take me 15 years, right? I paid the same, right? So in some ways, when you're thinking about diversification, you're thinking about, I'm getting the slow grind with the dividend, and I'm trying to knock some home runs out on the growth side. Thoughts about that? Yeah.
So, is it a truth or a trend that most dividend stocks are moderate to low risk?
No.
Okay.
So that's where you do a little bit of the digging, right? So let's use an example that I think we talked about last week. Let's look at Ford, right? Ford has been around for forever, right? They've been making Fords since the Model T, right? They've been making Fords forever, right? It's currently trading at $5.65, right? And when we look at that scorecard, we see a payout ratio of 0. Well, why is that? What happened?
They cut.
Did they cut?
Ran out of money.
They ain't got nothing loot.
They at one point in time was paying 26 cents, and then they cut it to 9. And then they thought they start feeling themselves a little bit and went up to 14. They got to the point where they ain't got no money. It's all bad now. You don't see no graph. You don't see no graph here. It's all bad. So just because a company is paying a dividend out, a lot of times what you start to find out is that, one, they don't have a ton of revenue, and they have, this might not be a good one to look at in terms of like payout ratio. Yeah. So you might see, like, if this was like maybe a previous year, I can't think of one to look at that might show what I want to show. But sometimes people will try to fool their investors and just try to get them to buy in on dividends, but they're using all their money to pay their dividends. They're not putting any money into the business.
See what GE looks like then.
GE?
Yeah. I know they cut theirs last year, I think.
Okay.
We bring good things to life.
Yeah, they sold
Y'all
up.
know too young for that.
All right, so look, their 5-year growth rate, you're right. They didn't took one to the face at some point in time, right? So now you look at the history.
You want to watch?
And in that history, it was all good just a week ago.
That light for me.
Right? Back here it was consistent. It looked just like AT&T looked, right? But my guess is, if you were doing, when that 2008 joint hit, they cut their dividend right here. And they tried to push it back up, and then they cut it again. And now they're like, to hell with it. 1 penny. They didn't gave up on it. They threw the towel in on it, right? So to answer your question, James, if you got in right here and you made some assumptions like GE is going to be a winner, but I guarantee you, if you was looking at GE around here and you would have done a fundamental analysis that we just learned how to do last week, you might have seen some warning signs, like even though they've been around forever, even though they've been paying consistent dividends for a long time, something is going on with this company, right? Something is not going right. So that's why I say just because Coke has been paying out dividends for 50 years, there's nothing to say that this wouldn't happen to them. You got to go and you still got to do the analysis. You can't just go with what the dividend is telling you.
If you look at the news on GE, I mean, Mark Davenport and I have been having this discussion probably about a year and a half now. He was trying to find a bottom for GE, but it would bounce back. And I'm going like, Mark, they're selling everything that they have.
Everything.
The only thing they have left is engines, I think. So their asset ratio is, bottom. They sold off energy. They sold off the finance part of it. I mean, they're just trying to get cash flow at this point.
Yeah.
Do that, they're selling off their business. So, so part of the analysis for me is always like okay, what's actually happening with the company? Yeah. Right. So.
Yeah. So I think
financial journals, you're probably used to it.
Yeah. So here's a quiz question number 1. So you do your fundamental analysis, but what are some of the other things you might want to think about when you think about investing in a stock that we talked about last week? Anybody?
Their peers.
Yep.
Okay. Peers, what's going on with them? What else?
You mean outside of? Oh, go ahead.
No, go ahead.
Something outside of Seeking Alpha. Something beyond this page. What else might we want to do?
Oh, go to their investor page or look at the news.
Go to their investor page. Go to the news. Right? Go to the investor page. Go to the news. Right? So we talked about Facebook last week, right? I texted to Godard. I don't remember off the top of my head what it was now, but I think from last Friday to today, they increased by like $17.
It went up another 5 after that. Oh.
Went up another 5 after that. Okay.
Yeah.
But the question is, why? Just because people started feeling Facebook all of a sudden? Anybody know why?
Well, there were 2 pieces of news about Facebook. Their streaming services I heard about, and they're adding a streaming service like Netflix. And there was another thing about their new meeting software or something like that.
Rooms. They've been pushing their Facebook rooms too, trying to position themselves somewhat like Zoom.
That's my
guess. That's part of it, but the big one was they're going to start selling stuff on Facebook. So they got in contact and connected with Shopify. And Shopify is a store that entrepreneurs, that's the page I use to sell my Hella Original stuff. And so a lot of people are using Facebook to advertise business, but they've never been able to sell their products on Facebook. Now they can. So they got a new revenue stream. And so that's what did it, right? But you got to know the news to have an idea of like, why is this stock shooting up like crazy for a week straight? And that's why, right? So if that works going this way, it worked going this way too, right? Because news always affects what happens with stocks. If they're going up and down, the news is always going to affect that. So I just want to start off with just talking a little bit about that dividend. The next 2 things we're going to do. Number 1, we're going to go over this homework. And then number 2, we're going to go over the second part of the homework, which is to tell us share a stock, share a company that you consume that is like slightly out of the norm so that we can look at it and analyze it. I'm going to start with the youngest person in the room, assuming that's you, Brian.
Oh, please don't.
No, not.
Oh, okay.
Not you should. What'd you learn? What'd you learn from the Trapper video?
Well, I learned a few things. But first, the stock that I was interested in talking about today was the Berkshire Hathaway B stock.
Okay.
and I saw he was invested in that, and that's a good idea to invest in like a company like Berkshire Hathaway, so you can go to like the investors meeting and things like that to kind of meet with fellow investors and gain insight and information from them. So it was very informative from that standpoint.
It's funny
And
because you kind of look at it, right? Like he was paying for the opportunity to be in a conversation,
yeah,
right?
but overall, it just kind of put a good spin on as far as like investing in stock, and you kind of broke it down that like I guess it was like minute mark 58. I can't remember exactly what it said, but it kind of gave you an idea of how the stocks work and like what made him get into stocks. So and that kind of gave me an idea of like where to start. Of course with you as well.
All right. Cogs, you do your homework?
Yeah. Yeah.
What were your thoughts? What did you learn?
Oh, well, I like the part about where you can basically have the company you invest in pay your light bill with dividends. You know what I'm saying? That was pretty good. But I also like the motivation that it gave you, you know, where, I mean, a lot of us, you know, like you said, we're in the wrong game, man. We're always looking for what they call earned income. And a lot of investing is quote unquote unearned income. You know, you're literally using your finger to do the work, you know? So I like that the best out of it. That's just me. Very inspirational.
Mickey?
So yes, I was gonna say like what Cog said too about the way he gave you a different way to look at the stock, you know, paying your using what you know, they're using the stock to pay your bills. Now, granted, depending on how many shares you have and how much of a dividend,
You didn't say
know, that could be realistic or unrealistic depending on, you know, what you got. But I mean, the sentiment is the same. So, you know, that part of it, I like the custodial part. You know, I got kids, so you know, he talked about, you know, what he got for his daughter. Like at age 3, she had $5,500. You know, so looking at the custodial accounts for your kids and just putting away that kind of money, you know, in a better way potentially than just putting it in a savings account. You know, but overall, just the whole breaking down, you know, breaking everything down to a not elementary level, but to a relatable level, you know, especially if you have any, you know, history in the streets or, you know, close to it. So
I thought it was just like, I felt like it's very digestible, right? Like anybody
yeah,
can pick it up and be like, oh, I understand now, which is why I wanted to share with you.
it's easier to listen to it and get it from somebody that looks like you and your family than it is an old white man sitting, you know, up wherever he's sitting.
Right, where you feel like it's not, like that's not for you.
Right.
Yeah. What'd you think, Brad?
I took notes. I stopped, went back, listened again. At the beginning, he hit me with a quote: "Education is limitless." So that I'm like, I want that on a shirt because that is so true. You know, you learn not only in a classroom but on the street, wherever. You may pick up a piece of knowledge anywhere, and it can be something that sticks with you. That you know, just that kind of just stuck out in my head. Um, I was intrigued with him with you know, just his correlations, you know, from the street to when he talked about washing his money. Everybody got out of jail. They trying to flip their money, get a barbershop, car wash. He was like, no, I'm putting these stocks. I was like, oh, okay, all right. You thinking a little head on. So it was a lot. It was a lot to digest, but I really enjoyed just hearing his perspective. Definitely, like Mickey said, about starting those custodial accounts for your kids. I kind of started just sharing stuff with my wife. I was really hype about that. For the stock, you know, that I want to look into potentially. I really started looking around. I was like, you know, been in this house like 3 weeks. I was like, okay, um, Virginia Power. We'll see. But then I looked at. I was like, okay, But I remember there was some power scandal, Enron. I saw like, okay, Enron, that tank, that wasn't good. You know what I mean? I'm like, that was, some shade with that. You know what I mean? So I'm like Virginia Power, not what was that? Columbia Gas. I'm like, just looking at things that are consumable for me, and also, with purchasing a new home, the company that we use for our lender, they sell off the loan. So I was like, okay, who are they going to sell my loan to? So it's this company in Cali. It's a small company. It started CMG Financial Mortgage Group. So I was like, I'm starting to look into them a little bit. I couldn't find a lot of information on them, but I looked at that, and then I don't know if we talked about it because there was so much to digest last week, but I don't know. Well, I don't know if I saw this in the video or in something else I read, but did he talk about like the day trader versus like the slow
He did.
trader,
He
the
did.
long? Yeah,
Yeah,
I
he
was
did.
like, maybe I'm more, I want to have a little bit of both, and I don't know if we looked at like the mutual, like trading, like the whole Dow Jones. Did we talk about that a little bit?
We talked about that.
Okay, yeah. So I was like, I started to just break down a little bit. So I was all over the place, but it was cool. It was a lot to digest. I'm still just taking it all in.
Yeah, and I think what you're gonna find, and the other brothers probably have already experienced this, is once you get a little nugget about something, it takes you down this rabbit hole, and you start learning more and more and more and more.
Yeah.
And I just had this conversation with Cogs a couple of days ago, where I was looking at Disney, right? I already had Disney, but I was looking at Disney, and I was going through the financials, and so I actually started to want to try to learn the things that weren't in bold and what they meant. And so in Disney, we had saw this section on the balance sheet about goodwill. And if I were to ask you what goodwill meant, you'd probably think, well, they gave some money away. That's what you would think. That's not what it is, right? So I was like, well, what is goodwill? And
Goodwill is the moniker of this house.
Yeah, goodwill is the moniker of this house. There you go. But it's a flash to be able to tell you they might have just invested in something big, right? So when you look at Disney, there's this year, 2018, I think it was it 2018, Cox?
Yeah, 2000.
All of a sudden, I saw this big goodwill number that was throwing off the balance sheet number, and I was like, well, what the hell happened in 2018? And what happened was they acquired Fox, right? And when they acquired Fox, they paid a lot of money for that, right? But it also became, although it was listed as a liability, that's an asset, right? And so it started to like clue me in to say, if I see any anomalies in that goodwill section, and we might see it later, if I see any anomalies in that goodwill section, that could then spark an opportunity for me to do some more research to figure out, well, what happened during that year that might be of interest to me.
The other part
2019, that's when it was. That's when they bought Fox.
Okay.
And see, and as part of that transaction, they had to write off some debt.
Right.
Right. So that's the other part of goodwill is how they balance out how much they actually pay for the company versus what debt they're actually acquiring on their balance sheet. They literally write that off as part of goodwill.
And how does that affect their stock price, right? Because companies like Disney, who have been around for a long time, they have like Coca-Cola. Coca-Cola could be selling for way more than $40-something.
Yep.
They've made a strategic decision to say that we want our stock to be accessible because that way we're guaranteed to have money pouring in all the time from investors. So Disney, while they're acquiring that stock, while they're acquiring Fox, they got to figure out how to adjust their stock so that it don't fall out of whack in pricing, right? So that they don't lose a lot of their investors, right? So that has a little something to do with it too. Gadar, did you do your homework? You watched the video?
No, I didn't watch no video, man.
I figured you didn't.
I got my own set of videos I gotta watch every day.
But I'm gonna ask you this question though, since you got your son right behind you. How long did you blink before he got as big and as old as he is right now?
Oh man, please. Dude just turned 22, man. I don't even know what happened.
And it happened fast, right?
Oh, no doubt. Today,
It happened real fast.
My youngest daughter turns 17 tomorrow, man. I'm like, I'm not that old. I can't.
And the reason why I highlight that is because, are we frozen? I'm frozen.
We're good.
We're good. We hear you.
Y'all hear me?
Yep.
Okay. All right. The reason why I highlight that is, because some of us got young kids. I saw, I've seen a lot of your kids on Facebook, and Brian was holding his baby last week or whatever. Like, some of us got young kids, and I'm telling you, they're gonna be big before you know it, like a blink of an eye, right? And so one of the things that I picked up off of what Trapper said that I thought was really interesting was this idea of, like, I'm in jail for 10 years. I'm sure that didn't feel like a blink of an eye, right? But, like, how much appreciation you can make in the stock market over that time period. And when you're living out here in these real streets, your kids grow up fast, man. And if you look at your kids and say, what if I would invest it? Like, Gadar's son wasn't alive Facebook wasn't around when he was born. You know what I mean? Google wasn't around when he was born, right? So you just think about, like, what if I invested in, Google when he was 10 years old? That money would be crazy right now, What if I invested in Facebook when they first came out? Not that was it $35?
$40, something like that.
$40, right? What if I had done that, right? And so I just share that to say that time.
Omar, because he said don't tell me anymore. But
I said don't tell me no more, so I told him myself. But time goes by really, really, really fast. So, there's the old saying of, like, there's two times to invest. Like, one, you should have invested a long time ago, and the second best time is now.
Yep.
Right? And so you can't ever have this feeling or concept like, I can't do it right now, or whatever the case may be. All of us got a little something extra to be able to put a little something on something, right? And those things can pay off. Like I said, even if it was $28 for, like, an AT&T, right? You just bought one share. If you knew you was gonna get $2 off of it in perpetuity, right? Why not do that? Did anybody not get a chance? Did you go? You did. Did you? You were first, right?
No, I didn't go, but so I think one of the things I'm a family guy. So anything that talks about progression of the family always kind of rings bells with me. So when he was talking about custodial account that he had for his daughter and the conversation at 3 years old that he was able to have with her about her having the level of understanding that she had at 3 years old. And some of us who are 40 plus don't even have that level of understanding. That was kind of inspirational for me. It's like, if he can teach it at a level where a 3-year-old can understand it, then what's holding me back from digging a little deeper to find out more information? Another thing that he said that I've heard before, but kind of sparked my interest even more, was that you learn more about things when you have to teach it yourself. And, as I was looking at, I woke up early this morning. My daughter just happened to wake up, so she was laying down next to me. And I was looking at Seeking Alpha on my cell phone. And she was like, what's that? And that created an opportunity for, like, I don't know a lot about what I'm looking at, but I'm trying to learn so that I can teach you. So she started asking questions that I knew the answer to, and it created a conversation that we've never had before. Yeah. So it sparked a level of interest in her. I was like, as I learn more, I'll teach you. So, that part of it is extremely inspirational for me. And just looking forward to those types of conversations that I can have with her, such that when she gets to the point where she's independent, she can say, I learned this from my dad.
Yeah. And part of the homework moving forward is I really just want you guys to spark up conversations with people, because you will learn more by just talking, right? And be like, man, I don't know everything, but this is what I'm picking up.
Oh, and I sent the video to 7 other people.
There you go. And I got a new video for you guys today about dividend stocks that I want to share with you for your homework also. So let me grab a pencil real quick. I know Brian said Berkshire, right? Berkshire B, right?
Yeah, that's correct.
He's a little high.
Yeah.
What's the I think it's BRKB. Is that what it is? The ticker symbol?
Yeah, BRK.B.
Okay. Jason, what was yours?
Moderna.
Moderna. So that's what's the ticker?
Hold on, I got it right here. It is mRNA.
mRNA. Okay. Yeah. Ron?
What you say? Oh, me?
Yeah.
Thermo Fisher.
What's the ticker?
MO.
MO.
TMO.
TMO. Okay. Godard?
J&J, man. Johnson & Johnson.
J&J. Winner, chicken dinner. Cogs?
Grubhub.
What's the ticker?
Grubhub.
What's the ticker?
GRUB.
RUB. Okay. That's convenient. Brad?
I don't know mine. So
T-Mobile.
no, I ain't doing T-Mobile though. No, I'm messing with T-Mobile.
I'm just playing with your Brad.
Yeah, I know. But yeah, any of is see.
You don't have to know. You don't have to
know. Okay, so
you're still gonna be a part of this exercise, so you don't have to know.
Oh no, that's cool. Yeah.
Mickey?
Mine was Nintendo.
What's the ticker? You're on mute.
You're on mute, man.
You're on mute.
NTDOY.
My bad. NTDOY and NTDOF. The DOF is the full share.
Is that an OTF?
You speaking Greek now. What?
Five-letter triple symbol.
Oh no, it's Nintendo.
All right.
My kids play a whole lot of Nintendo, so.
All right, so Godard, I actually start with you. Walk us through this J&J.
All right, so I like J&J because I made money my way on it this week.
Yep.
So they actually had a pretty good week. But from a long-term perspective, you pull it up. Oh, you want me to? You got it up. Oh, it's coming.
Yeah. This computer has so many bugs in it. Sorry, guys. All right. So you did the fundamental analysis on it?
Yeah. It's not 100%. It's not a Facebook. Everything is perfect, but a couple of things I did like about it. It's down the last 5 days, but again, this is long term, so I can't count it that way. If you go to the summary real quick, just looking at the
5 year.
Yeah, 5, 10, whichever one, doesn't matter. So just looking at the chart. So yeah, it's not a perfect chart, but it's a growth chart from that perspective.
Yeah.
So besides the little COVID dip in 2020, it was relatively stable, all intents and purposes. And I also like the fact it gives you opportunities to get in at a discount.
Yep.
All right, so key data. And again, I'm not as proficient as on this, but again, this is to me is a glance test, right? How does it look when I get my free credit score? Sweet.
Man, I don't know what she got on the computer. It's a problem. I don't even know what this stuff is.
All right.
But yeah.
All right. So the income statement, I looked at total revenues and continuing to move up. So nice solid trend there. Gross profit, same thing, continuing to move up nicely. In relation to and their cost of revenues, which I know is their SG&A and their other expenses. They're relatively stable for a company that's actually growing. So I actually like that part. And operating income, all right, had a little bit of dip in 2017. Actually, the end of 2017, because some reason they have January and December 2017 on this one. So Went down 3 billion, and then it came back up the next year, and it's been relatively stable. So they have plenty of money to operate, which is always a good thing.
Yep.
All right. Was that it on this one?
Well, let me pause for a second. Anybody want to have any thoughts on, what might have happened during that operating income situation? Anything poke out at you?
Maybe they acquired another company. No.
Okay. So the operating expenses.
They jumped up 2 million, roughly.
Put a B on that.
Put a B on that. Yeah. So it looks like some research and development expenses, which is never a bad thing, right? They're doing research and development to try to figure out. Maybe they're coming out with some new baby powder or something. I don't know.
Remove the talc out of their powder, whatever.
Or remove whatever.
Hold on. So I was listening to the news this morning, and it said something about them removing talc powder from their distribution altogether because of
in the U.S.
Because they're getting sued
in the U.S. Yeah.
Yeah. So
which is actually
and their operating expenses, it's still about average from what it was.
Yeah.
But just a little insight, maybe some additional research and development, a little bit more, not a lot, but a little bit more. Okay, go ahead.
There will be a tax hit coming up here shortly, because if you look at what happened with their earnings from continuing operations, that same period, they had a hit on. You look at their income tax expense right above that. So they're like that line right above. No, go income tax right above the earnings.
Oh.
Right above the bold one, man. No, go back down.
Okay, sorry.
Yeah. So you look at what their expense ratio went to from 3 to 16.
Ooh.
So something happened there where there was some sort of tax hit or something, whatever that was.
Yeah.
I tried to look at the EBITDA, but I couldn't figure out what it was, so I didn't go back and research.
But it's an anomaly. It happened, and then they're right back to where they were.
Yep.
Yep.
And then same thing. So that trickled down to net income.
Yep.
Which you see the dip and then kind of the recovery. So I like the fact that last 3 years they've had a pretty strong recovery.
Yeah. So just real quick, guys, this earning from continuing operations in general is going to be the same as its net income. Is going to be the same as it, unless something happened with like some minority interest. That's usually where that number changes. But for the most part, you'll notice that these numbers are identical to one another. It's usually this section right here where something might change. Okay, and then we looked at the earnings per share.
Yeah, the basic one. Again, earnings per share, except for that 1 year, pretty consistent from that perspective.
So you know what I'm really curious about, and we can look at this. What I'm really curious about is 2017 is this year, right? So we looked at Johnson & Johnson. Let's look over here real quick. Johnson & Johnson right here is one of these aristocrats, right? They've been paying out for 56 straight years. But we'd also know that in 2017, there was some stuff going on, right? So I'm really curious. Well, I'll go back, but I'm really curious, like, what happened with their dividend in 2017? Now, I can already assume the answer, but let's just look real quick. Dang, this is so buggy. Annoying. Let's look at this dividend history, and we're gonna go to 2017. Right here, guess what? Ain't nothing changed. Didn't matter. 2017. As a matter of fact, they went up. They increased their dividend. Well, it was at 80 cents. Then they went to stayed at 80. Then they went up to 84. This all happened 2017. 84, 84. So even though they that random anomaly, it had no effect whatsoever on their dividend payout.
Yeah, and one of the things that would tell me is that the leadership didn't have any concern about whatever that anomaly was. They knew
Correct.
one-time impact, and so they weren't panicking to cut dividends and all that kind of stuff to save money. And they also weren't cutting headcount, which is also another. That's normally where you'll see a big hit. If
Yeah.
something's starting to go down, because that hits your SG&A expense, your sales, general, and administrative, and so that's literally headcount is what that is, what that number is. So you cut headcount, then it's like an automatic drop straight to your bottom line. So if they're not cutting headcount, then that's all a good sign.
All right, so let's, before we move on from this income statement, other thoughts, questions? If you got any questions, ask Dart. Just on this income statement, or any thoughts?
Nope.
Okay, we're good?
Yep.
All right,
All right, balance sheet.
check out this balance sheet. Hopefully you won't be looking for a free credit score when this finally comes up. There we go. All right.
All right, so total cash now, if you look at their numbers, the last, what's that, 16 and 17, 38 billion, 41 billion, there's that drop, 18 billion, and now it's starting to recover. So a little lower this year coming up, but I like the fact that it's consistent, or it's a little bit higher, or whatever the case may be. So they have money.
They got money.
Yep. Receivables is moving up. So look at their assets. And they had a little bit of drop in 17, but again, now starting to, it's recovering again. And it's a little bit down, but to me, that's okay because, you know, again, Johnson & Johnson's been around forever, so I'm pretty sure that whatever this is, they'll continue to recover from it. So
Yeah.
everybody needs baby powder.
Yep. So we're looking at those assets in 2019, and we see $45 billion, right? And if we look down and compare it against those liabilities, right, we're at 35 billion, right? So we still plus 10 billion.
Yep. And that's actually pretty consistent. Actually, they're a little better than their peers. We haven't looked at that tab yet, but they're a little bit better than their peers as far as the ratio. So, and you look at, was that current, or we're looking at current, right?
Yeah, that's current.
Okay, so if you go down to current liabilities, 38, we didn't look at total liabilities because that's longer term liabilities. Okay, so yeah, current assets 44, like O said, and then current liabilities 35 or whatever. So
yeah,
life is good there. I don't think we looked at anything else down here, did we?
Yeah, so one of the things that that I looked at, I'm trying to remember, is this stockholder equity. This stockholder equity is a man, what is it? Is it the shoot? I feel like yeah, so the stockholder equity does this math for you. It does the math for you of the difference between the total assets and the total liabilities.
Yeah.
Right. So let me just confirm that. So the total assets here are 133,411, and then the total liabilities are 62,261, and then what we have is the total equity, and as you can see on my little screen here, 71,150,000,000, and that's the same number, right? So before, when I was last week, I was saying we could look back and forth on the current liabilities and the current assets, but if you want to see the total liabilities and total assets, all you got to do is look at this stockholder equity right here, and there's the math for you, kind of right there. And so, like Gadar shared, we did see some stuff going down, but again, they ain't got too many big problems over there. Then let's see.
You look at their employee counts. That's what I was saying. Like even back in
2017, they increased their employees.
Yeah, so that actually has a hit on there as well. So again, something happened. All right, so they had to grab another 8,000 employees. I don't know if it was a acquisition or if it was a expansion. But you talk about, if you average out how much an employee is, you're probably talking about, I would say 100,000 for an employee. If you look at just salary as well as benefit costs, etc. So 100 times that's $8 billion by itself.
All right. Any questions on this balance sheet? Any thoughts? And what I mean by questions is like, is there something you're confused about or don't understand or need clarification on or wonderings, any of that?
I just want to refresh that. Remember, an asset is something that you can make future money off of, or it's what you got. A liability is something that'll take money away from you, and what you have left over after money comes out is equity. That's all I'm going to say.
Yeah.
Cool.
And that's where that stockholder equity down here comes in. Right. All right. Any others?
So with the stockholder equity, the higher the number, the better, or is it? I'm looking at going across.
Well, at the end of the day, and I'll let Gadar share his thoughts.
Mm-hmm.
I want that to be positive, right? Because that's going to tell me that they have more assets than they have liabilities, right? And we want money. We want more money coming in than we want going out, right? So there is maybe some reason for concern here, but again, we're talking about $59 billion remaining. Okay, it's not like, oh man, they're losing a lot of money. Like, nah, this is a plus. This is what they got after their liabilities have gone away, right? So even though we see somewhat of a downward trend here, and then just FYI, I didn't say this last time. This section right here, sometimes it says last reported, sometimes it says TTM, which is basically like a trailing 12 months. So wherever we are, so what's today, March 21st or whatever, 22nd? So it would basically be from March 22nd of 2019 to March 22nd of 2020.
Hold on one second. I want to see if I want to see when their earnings was. I didn't even look at that. Because that may be what the last report date was. They should have done their Q1 earnings by now. Normally my let's see. Don't worry about it, man. It ain't that serious.
Yeah.
I was trying to look for it on mine as well, but I got my chart set up a different way right now.
So
earnings. They actually
the 22nd.
They paid dividends today.
Oh, today. There it is.
Yep. They had their earnings call. They had their earnings on the 14th of April.
Okay.
And they actually beat earnings. That's actually good.
Yeah.
Probably see a little bit of rebound right there. But the dividend payout today was $1.01 for the quarter.
$1.01 for this quarter, so that'll be $4.04 in the year.
Yep.
Yep.
Around 140. Well, yeah, it's 144 now.
They pay for $144 to get $4.
Yeah, but
Right.
think about it, like when at the bottom it was like at 108. so
Right.
so it's recovered pretty nicely.
All right, so we're gonna go over to the cash flow.
I'll do this one real quick. The bottom line, they have cash. And let's see, net income is going up. Right, you see that again, that December number where it dropped.
Yep.
And then cash flow. So cash from operations, that number is either going up or is pretty pretty flat, which
Yep.
is a good thing. It's not going down.
Yep.
They invest against a pharmaceutical, type of consumer goods. So they spend a lot of money investing. If you look at that investment right there in 2017, that was a 4-time normal cash from investing. So I'm not sure what that was.
Yeah. So my guess is we could do a Google search, right? And this Johnson & Johnson 2017, and we could find some news.
Yeah. But to me, again, at the end, it's a one-time deal.
Right.
So what I see after that is a consistent pattern. So if I was really that curious,
and that even plays out in this graph, right?
Yeah.
It's just that one moment.
Yep.
And everything else looks about the same.
Yep. So, and then look at their debt. They've see short-term debt. They've actually curtailed that a lot since 2017. So they used to be having a lot of debt issued. Now we're talking peanuts compared to that.
Right.
And then you look at what they're repaying. They're pretty consistent that they're repaying their debt, trying to get their debt. And I don't know if they're doing that via if they're doing stock buybacks or what they're doing with that one yet. But bottom line, they're using some of that money to pay off their debts.
Yeah.
J&J bought somebody in 2017.
Huh?
They bought somebody.
Somebody?
Well, where do we see the let's see the where's that goodwill at?
Right there.
I don't think that's the one. It's another one.
About 30 billion.
Hold on. Was it on the balance sheet?
Why are you doing that?
It's about $30 billion.
Oh, here we go. Well, now that's relatively something happened. A little bit more. They did something. They said they did something. I don't know what. But again, if you wanted to dig a little bit deeper on that, you could.
They bought a company called
X Lion or something.
Atsalon, a Swiss company.
Okay.
Yeah, so they bought it for $30 billion. Yep. I don't know what it did for them, but they recovered whatever it was.
And the same thing here, guys, in terms of like bottom line kind of thing. So basically what you're going to see here is they're going to take cash from financing, cash from investing, and the cash from operations. And then here's your number. All right.
Last thing I glanced at. Are we done on this page? Everybody good on here?
They also got some cash flow, just money sitting around. That's been going up consistently as well.
Yeah, I looked at their peers real quick. Oh, the other thing I like about this, they actually had options on there.
Oh, did they?
Actually, yeah, they do an options chain on there. I wouldn't use it, but there's an options chain. It's in that. It's in the key data. But peers here, J&J, P&G, 3M, and Coke. I don't know how Coke is a peer, but I think some of their subsidiary companies maybe they're looking at, but but you look real quick, look at their market cap, and I looked at revenue growth, positive. It's not as high as P&G, but I think there's some other things that actually outweigh that. Come on down for me. I'm trying to see where look at their profit margin. So 66%, P&G's at 51%. And one thing, and a lot of companies look at this, and I know we didn't talk about it last week, but if you look at their income and revenue per employee, down the last two at the bottom, every company I worked for, I worked for like Nextel way back in the day, we used to look at whether or not we were going to add employees based on how much revenue per unit, per device we actually brought in. But if you look at that number, they're bringing in 600, they have 130,000 something employees. Each one of those employees is bringing in $620,000 revenue with $130,000 of income. So think about that for a second. The employees aren't getting paid that. That's just what they're generating for the organization.
Man, I don't know if people want to know that. So
that's what I'm saying. You think about it. You are worth. Each employee is worth $600,000 to them.
New slaves, Kanye wrote a song
about that is crazy.
I think about how much you're not getting paid. How much the company tells you you're worth.
So your $100,000 salary, your $200,000 salary is great, or whatever. Your $50,000 salary is also, on average, you are generating that much for that company.
And according to their peers, like they're double of 3M, right?
Yeah. Yep. So it's crazy. And that also tells me that 3M is spending a lot more money somewhere because their actual revenue for employee is actually higher, but the net income, how much they get after they pay everybody is half or more.
And the same thing with Coke, right? So at Coke, you're looking at their gross profit margin is about the same as J&J, but the revenue per employee is so much different.
Yeah, but then their net income is pretty close to. That's the thing. So that's to me, that's a very efficient, very productive company. That's how I look at that one.
That's a good way to look at it. I mean, I hadn't thought about that, but it is. I mean, I think this is a sign of a company's health. Right?
Yeah,
how healthy is the company?
I guess being in HR this long, you start looking at numbers that way because that's again if we're gonna hire people or not hire people, that kind of thing. So,
when you talk about looking at people and how much are you worth? Wow. Okay, I learned. See, this was good about this year. Everybody get a chance to learn something. I just learned something. All right.
Stock price performance. I don't think dividends go down. I don't think anything. We don't do any on the EPS. Dividend yield is cool. I don't think there's anything else on this one though. Yeah, I mean the 57.
Check this out. You're talking about these are all on that dividend aristocrat list.
Yeah.
Right? Every last one of them.
Yep.
57 years, 63 years, 61 years. Yeah. And then this dividend rate, this is what they assume moving forward. So we talked about earlier about, you said it was $1.01, right?
Yep,
so here's what it would look like for the year, and then Coke, it would look like $1.64, but also you paying a third of the price, I think it was, for Coca-Cola, right?
Yeah. So percentage-wise, you're getting a better return for your investment. But the thing I also like is even though the market's been down, if I look at J&J, if you look at their return over the year-to-date versus, in the 1 year compared to some of their peers, they are, at least they're positive, so they're actually going up a little bit.
Yeah.
Because everybody's taking a hit in this last quarter.
And this is crazy.
Oh, yeah.
A 10-year return on investment, 227%. That's crazy.
Not
And
bad.
it far outperforms their peers.
Yep.
And even with the revenue, look at their revenue. And the profit.
Yep.
So yeah, this little, so like we can, I mean, obviously with the fundamental analysis, you can look at all this stuff, but I like this kind of summarized overview page because it does all the math for you, right? And you can just like look at this stuff at a quick glance.
Yeah, you get the quick version of what it is compared to everybody else.
Yeah. So what you think, Brad? Would you dump $144.37 in J&J? You had it?
Brad's all in.
Well, going by Big Brother Goddard, I am. He said it was a healthy stock, and I'm just looking at, it is. I mean, and then I also remember from last week, you don't necessarily have to look at the $1.44 per se. Don't pay so much attention to that. So
Yep.
I'm switching over. I'm off of T-Mobile. I'm moving on.
Anybody have any reason why they, aside from like that's a little rich for my blood, right? So, but I think the one thing that's really good about this, we start to make these comparisons again. Like maybe I don't have $144 or whatever, but Coke is affordable for me, right? And they're in the same range, right? I don't even know what Procter and Gamble is. I know 3M is pretty expensive. I don't know what Procter and Gamble is. We're about to find out.
They're actually, they're 112.
All right, so a little bit cheaper, you know what I mean? But, I think that what I love about the peers section is it gets you to start thinking about like what else might be out there. If you love everything there is to love about Johnson & Johnson, but you can't really fool with them the way you want to, that might be a way to pull it off. And then, I was going to share this website with you guys. It too is a little of a buggy website.
I had a question about price.
Yeah, go ahead.
So, I mean, because I would probably go with Johnson & Johnson. Now, I think my concern would be price.
Yeah.
But I'm as far as like price action, like at what point would be like a good entry? I mean, if it's looks like it was down like a couple
so
pennies, but what would be what's a good number to say? Oh, it's down point whatever percent. Okay, this is probably a good time to get in.
Well, the Goddard probably has a technical answer for that, but my fundamental answer for that, a quick way to do it, is last week when we talked about looking at these dividends. So if a company pays out dividends, this only works if a company pays out dividends, and then you click on the dividend yield. What we're going to get is a graph down here, right? And when that graph pops up, it's going to tell us when. So the lower it is, the less of a deal it is. Yeah. The higher it is, the better of a deal it is. So the best time over the last 5 years to have bought Johnson & Johnson was on May 5th of 2018, right? Mm-hmm. And so when we look at this dividend yield up here, we see that the 4-year average is like 3.13%. Currently, it's at 2.83%. So technically, it's pretty expensive, right? So, but if we go back and like I said, it was 5/1/2018.
Yo, go to that 2020 spike right there. I'm sorry, when you finish.
Okay. 5/1/2018. So,
yeah, right there. You're in there somewhere.
So somewhere here, right? It was at a deal. It was at a real good deal. And that is played out from that dividend yield. So if you just use the dividend yield to be able to tell you, so maybe like, all right, oh, this is Procter and Gamble. Sorry, this isn't even Johnson & Johnson.
Exactly the same though. In the same sector.
All right, so here we go. the time to bought it would have been, you know,
COVID-19.
March.
the COVID-19 time, because it took a hit, right? It took a hit, and it has since hell of recovered, right?
Mm-hmm.
And where it's at now, in comparison to the 4-year average, it's about what you would normally pay for it. So it's actually moderately priced right now. This right here tells you, even though you see this number and that feels like a high number, that's about what it costs.
Okay.
And you can tell that just by looking at this dividend yield, right?
Mhm.
Whereas, we look at, say, AMC. I just want to give you the opposite of that. You'll see the dividend yield is 13% versus 9%, right? Which means it's a good, based on that, nothing, none of the other information. Based on the dividend yield, it's a good buy.
Well, look at the chart.
It's cheaper than it would be, and the best time to buy would have been April the 12th, right? Because it's so much higher. Like, this is what average is, and then it started to get a little bit cheaper, a little bit cheaper, a little bit cheaper. So right here, if I bet you if we were to look at the chart, we would start seeing the stock prices dipping beginning in 2018. I guarantee you, we go here and we look at this summary, and we go a little 5 years, and we start at 2018, and here we go. Like, the roller coaster has begun, right?
Mm-hmm.
Started going down, 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 down.
That last 30 handle, probably the stock price would be like $1 or $2.
Yeah. So I bought it at $2, $2.17.
We bought it at $2.
All right, so man, good stuff. Who wants to go next?
You can be shorter than me on that one.
All right, Brian, you're up. You wanted to look at that Berkshire?
Yeah, and I only chose this one because the company I work for gave us stock, and I kind of want to analyze to get a better understanding of how it works.
All right, so what'd you do first?
Well, I looked at the.
But you got free stock, right? Brian?
Yes.
Oh hell, you good.
So right off the bat, what do we see?
Like, it was doing well up until COVID-19. They, of course, like, it's like a trend for like a lot of different stock companies right now. So then I went to the key data. And then I looked at the bold trend as far as like the total revenues, and it's been increasing over time over past
5 years.
Yeah, past 5 years.
Yep.
And the cost revenue has been about it's been going up, and then it's like decreased in the last year to the lowest point. But the gross profit has kind of dwindled down, but then it had like a huge jump in 2019 for some reason. I'm not sure why.
That's really interesting.
Who they sell?
Yeah.
They must have sold a hell of a lot of something.
Sold airline. Sold something else.
Yeah, what happened?
I can't recall anything on like with the company I work for, but I'm not sure if the other companies have any impact on that. Well, I mean, of course they may have, but I'm not sure like what actually happened on this time. But it was it's outrageous.
Yeah, well, so the thing to think about is that, and anybody can correct me if I'm wrong, but Berkshire Hathaway is kind of like an ETF, right? So
Yeah, it's like a conglomerate of stuff.
And so in terms of profit, I'm wondering what they consider as profit, because it's not like they're selling, a product as in like, some consumable product. Maybe they're selling service, or maybe they're selling, I don't know.
Well, this
is weird.
This is a roll up for them, right? So, like, does anybody know who's in this portfolio?
Well, I know Geico is. I work for Geico, and that's one of them. And then they have a realty company, but I'm not sure who else.
They got a railroad. They got a what's that? Not Tasty Freeze. What's that place called?
Yeah, I know. What's the
Dairy
name?
Queen.
He likes banks.
Yep.
So I'm sure there's a lot of banks in there.
We just sold off banks.
Just sold them all.
And airlines. He sold airlines too.
He likes banks. He likes airlines. I know Coca-Cola's in there.
Yeah, Coca-Cola's is number one.
And yeah, Kraft and Heinz is in there too.
But yeah, I don't know what. I can't explain this. All right.
And this is what I looked at from there. Then the net income, I guess.
Oh, the net income. Okay.
Yeah. And it's been consistent. It's increased, but then like of course the 2019, I'm not sure what happened there. During that time, but it's kind of.
Let me let's look at something real quick.
Okay.
Okay, so
No, I'm looking. I want to see overview. So I want us to understand that this is not a normal.
Yeah, it's not a normal stock.
It's not a normal stock. So what we're looking at is going to be kind of. So let's see. They are into insurance, freight rail, transportation, utility businesses,
Everything, man.
insurance.
So, Brother Gay, are you going to the annual meeting? Yeah.
No, I haven't done it.
I saw that part.
1.5% of Apple shares. Y'all want to guess how much that was worth?
A lot.
Somebody throw a number out so you can laugh.
1.5%.
1.5%.
3 billion.
No, not that much. 800 million.
800 million.
Yeah, 1.5%.
You say 800 million is a billion to me.
Yes. So Brian, this company is certainly outside of the norm. They've got their hands in a whole bunch of stuff.
Yeah. Okay.
I know we're going through a flow right now, but I'm just really curious about who their peers are.
I looked at that and saw it was like a multi-sector industry portfolio.
It can't be anything normal. I mean, they got
And look at this here.
Right.
That sounds about right.
Yeah. Yeah, I don't know.
I could probably pick another one.
I don't know. I mean, no, I think it's good to challenge ourselves and look at stuff that's not normal. It's just hard. It is hard to follow, but let's continue with the process.
It was confusing for me, like when I was trying to analyze it.
Even with the earnings per share, it just takes this weird, crazy dip right here. Yeah, I don't know.
I think you're right though, man. This is like an ETF where it's like you just look at whatever their holdings are in their portfolio.
Yeah.
Stocks individually, kind of what's going to happen with this.
I mean, I think what you shared earlier is that it's part of the offering that you have at your job, right? So
yeah,
it ain't like that ain't a bad deal, right? The flip side is that, could you create something that made a little bit more sense, right, for yourself, if you had a choice? And if you're investing, part of your mindset might be, well, if I'm investing in Berkshire Hathaway, I'm invested in Warren Buffett, right?
sure. Yeah.
Warren Buffett is 12,000 years old. You know what I mean? So like, Someday, just like with Apple, like I don't know what happened with Apple stock when Steve Jobs died, but I'm willing to bet that it took a dive for a minute, right? And so you makes you wonder, like, what is there going to be fear around, Warren Buffett as it relates to Berkshire Hathaway? But I don't understand. I think it functions like an ETF, but I'm not really sure. So I can't give you any answers on that. But if it's through work, like, it ain't gonna hurt you.
Right. That's not like it's.
But well, it kind of hit me when because I wasn't keeping track of it. It kind of took a hit, like when the COVID started. So it like dropped from maybe 230 to like 170 something. So.
Uh-huh.
Yeah, it got down to 162. The only thing that
so
the other thing that troubles me with this one is, like, most stocks have made at least a 50% retracement as a rebound to where the bottom was after COVID. And this one started doing that, now it's starting to trend the other way. And again, this is a short-term look at it. It's not a, I mean, that's something you just keep in your portfolio until you're ready to sell everything, because I don't think, Berkshire is not going anywhere. And
Right.
they got $100 and something billion. They haven't bought anything since like 2016, like as far as bought a company. So I know they're just sitting on cash right now. So like,
Yeah. So I'm sure you saw their assets went up, right?
yeah.
And then let's look at the stockholder equity. So they ain't got no problem with money.
That's it.
If we look at that, like, we stop and press pause for a second. Johnson & Johnson, that was like, what was it, 68 billion or something?
Yeah.
The stockholders' equity, total equity, is 258 billion, and then it's gone to 285 billion. And we go to 351 billion, and there was something that happened this year. If we go back to those other pages, so I got a million problems, but money ain't one of them.
I mean, that's like almost half a trillion dollars right there.
Yeah, so we can almost throw the baby out with bathwater on all that other stuff.
They have to. Because it's not a separate company.
Jeez,
I
Louise.
want to see what I want to look at the Berkshire 8 numbers real quick. I'm looking. I want to see something.
Oh, this is big.
Yes,
That's the Howard.
It must be using the same number because it's the same company. Yeah. Okay.
Berkshire ain't gonna cost a lot more though.
Oh, Berkshire.
Yeah.
Who?
That's an
What in the
understatement.
world, man?
Who got a little something on that?
Yeah, you can get a fractional share.
Hello original.
Hey,
Hello
can you buy
original,
me a couple
baby.
shares?
Yeah, I get you a share.
Hello original. Yeah.
Sell my house and buy one share.
I'll sell
So
my
it-
house.
So is this the most expensive like stock? I mean, I don't know. Just
I
random
think
question.
so. Yeah, I think this is.
It has to be. Jesus Christ.
This is why they set up the B side, because you can't afford this.
For the broke people. Be broke.
The A side is more institutional investors.
Affluent.
That's companies, man. That's not people most of the time.
I got you.
Top
I'm learning.
0.1%.
I'm learning. Yeah.
Clearly.
So yeah, it's the same number. Same number.
I was like,
Yeah.
But yeah.
Like that, I'd be like, I'll buy some.
So that's money ain't a thing. Money's not a problem. And I think that's all you need to know about that.
Yes.
Well, I was wondering if I should get some more. Like, can I have the option to buy some more too? But I think it's like a discounted rate though.
Yeah. Is it a stock purchase plan?
Yeah, it's a stock ownership plan. Yeah.
15.
Oh, that's get in on
Sorry,
that.
can you repeat it?
It's like a 15% discount, right?
So at least I had to verify, double check it.
So, yeah, because that, my company has that, and you got two things to look at. What they normally do is they'll look at the first day of the quarter, and the last day of the quarter. They should take the lowest price and then take that as your base 15% off of. So when you look at that, you can tell whether or not you should actually get it because you'll see if you're actually getting a real discount or not.
Okay.
You know what I mean? So if you see if the price is going down, and the stock price is still down, it may not be worth you buying it for that month, for that quarter. So just make sure you're getting a discount off of the price, I guess is the best way to say it.
Okay, that makes sense. All right, thank you.
Are you getting the price match also?
I don't know.
So
I had to double check it on the.
Yeah, because if you're putting in X amount of dollars and they're gonna match you.
No, we have a profit sharing plan. So they give you like a profit share the profit, like at the in the first quarter of the new year.
Okay.
Yeah, most employee stock purchase plans they're not matching. It's just you get a discount.
I was about to say if you'd be doubling up if you had that.
But for me, one quarter it was like a $30 discount off the price. But then the next quarter it was actually a loss. It would have been a loss for me to actually get the stock purchase that plan because of COVID and the price was dropping. So
yeah. Okay. Well, yeah, I think we've seen what we need to see on that one. And just as a quick little aside, there are companies that'll give you two versions of their stock. They give you the affordable version. So for you Hennessy drinkers out there, and I think Trapper talked about this, right? You have LVMH, which is all the luxury brands.
Just keep buying them up, man.
Moet, Hennessy, Gucci, all that stuff is in here. Yep. This version of it's going to cost you $389, right? But there's a cheaper version. As soon as its computer decides it wants to work. Basically LVMUY. And it's the same, the numbers are going to be all the same, except it's at an afford. I think it'll be like $70-something. $77. So if you were interested in investing in Louis Vuitton and Gucci and Hennessy, you could do it for $77 versus that $300-something. But of course, still doing the same kind of fundamental analysis that we've been talking about this whole time.
Man, as a fundamental, I think about how much Hennessy I purchased, and I'm like, I could have been getting money, could have just peeing it out a couple hours later.
Somebody got that pure white over there.
Brad drinking that pure white.
Then there's another one that the Crown Royal is under, where it has a whole lot. I can't remember the name of it off the top of my head right now. But there's another one that has like all the alcohol. I mean, it's got all the alcohol. It's the one because I asked Cogs this question of who owns Ciroc, right? And a lot of people's first answer is Diddy. Like, no, Diddy does not own Ciroc. Actually,
no way.
Diddy is not. What was it?
He has a piece of it, but it's like I think he has an equity share, but he doesn't own it.
Who owns Slit Smoke Liquor? Billy D.
Slit Smoke Liquor.
Oh no, who owns
Billy D, baby. Billy D.
Billy D.
I let my hand fall.
At work.
Lando Calrissian.
Forget the name of it.
Yeah, Wikipedia will probably tell you on the right side.
No, Diego, that's what it is. D-I-A-G-E-O.
Ah, that's who we were looking up. Yeah.
That's what it is. D-I-A-G-E-O. And then D-I-A-G-E-O, investor relations. You'll see all of them right here. Because it's all these consumed alcohol products. So if you're a drinker, you know what I mean, might as well be paying yourself. Our brands, oh my God. So there you go. There you go. There's your Guinness.
Oh yeah, okay.
Smearing off.
There's a picture of all of them.
Ain't got that Mad Dog though.
There you go.
The realest.
So there's the lineup.
Oh, they got the black label.
They got the black label, the Captain Morgan's, Smirnoff.
Baileys. You want Baileys? Trinidad.
Got the bullet.
Tango Ray, Tango Ray, homie. Tango Ray.
Hey, in the Bay, baby.
So,
Easy call.
so if you don't see any of these things going down anytime soon, right, is people going to stop consuming any of this stuff?
Not as long as hip hop is alive.
As long as hip hop is alive.
That's right.
Well, as long as it's a Friday.
So you can go this route.
So it was essential for them since the beginning of COVID.
Exactly.
See, in DC,
You're right.
they ain't gonna be consuming it. We don't have no nightlife and no bars till phase 4, so I don't know.
As long as we all on a sick and shut-in list.
Just sick and shut in.
Oh,
Yeah, so
I don't drink.
So, and then this was the LVMH.
That's a nice website.
Man, it's luxury, bro.
Luxury, man.
It's luxury.
Look, top
Oh,
right, top
gosh.
left hand corner is the stock price already. They give you stock price on the top.
Top of everything, top of the line. Here's a Hennessy, Belvedere, whatever this little wine is.
XO, Henny XO.
We got the Louis Vuitton levers, perfumes and cosmetics. This is all the luxury watches, jewelry. Sephora.
What? They on Sephora?
They own everything.
Sephora's a big deal, man.
All the luxury, LVMH, right? So, maybe it's out here and you could own it. Long story short, the point of my saying that is out here, you could own it, right?
And I recommend you buy black-owned products and buy that stock. Boom. That's what I'm saying. I'm just saying. Black out.
So, Ronnie, you want to look at yours, or James, you want to look at yours, or?
You talking to me?
I'll go.
Mine is different. Go ahead, James.
So mine was actually inspired by the conversation. There's a theme here. It was inspired by a conversation with my daughter. I asked her if she had the opportunity to invest in something not even knowing. She said Sour Patch Kids. So I looked up Sour Patch Kids and found out that they fall under the J&J Snack Foods, JJSF, I believe. So are you bringing that up in
What's the stock ticker?
JJSF?
JJSF.
Yeah.
Why did I write that down? Did I ask you? JJSF. Oh.
Yep. JJ Snack.
All right. Sour Patch Kids, huh?
Yeah.
Okay.
So of course you look at the 5-year summary. You see progressive growth except for this COVID situation.
Man, there must have been a hell of a lot of Sour Patch Kids happening in 2019.
Well, I mean, it's a lot of other things that fall under that grouping up, but so started off looking pretty decent.
If you don't mind, I'm just curious. JNJJ.
No, JSF.
JJ.
You said JSF?
JJSF.
Johnson Snack Foods. Nah, man. Nah.
2 J's, an S, and an F.
Yeah.
2 J's. That's right?
Yep.
2 A's. I had to. 2 A's in a big.
Moving over there, Cogs.
Cogs wild.
All right, so you're gonna invest in this guy? Is that what it's all about?
Hey, he can look like Homie the Clown. I don't care. Make my money.
I just want to see what. Oh, here we go. Products. I'm just curious. Aside from the gummy bears, what else they got going on? You know that already?
Fruit, snacks, products.
It's a lot of different snack foods.
Oh, they got icy. They got ice.
Okay.
And they made that icy, man.
They got icy, soft pretzel, churros, funnel cake.
Whole Foods, that wasn't even all of them, or whatever it was.
I won't invest in them. They got Luigi's, man. That just disappointed me.
See, you can go to the right. The right arrow. Yeah, scroll to the Oreo.
Oreo churros?
What?
I said in the COVID, when I saw shape-ups, I thought about haircuts.
Paradise, sweet stuffers, pause.
Pause.
Sour Patch Kids. Okay, this is interesting. I mean, kids be coming up with stuff too, man. Like you wouldn't even thought about it. Okay, all right. So let's look at the data, man. I'm interested. All right.
So look at the looks like things have been relatively stable. Going up, looks like there might have been a little bit of a hit, of course, going into what did you call it, the year where it's marking from now and a year prior to now, I guess the TTM, which we were talking about earlier. So that's the current 341.6 down from where it had been going up over the last, I guess, 5 years or so. But it seems like everything is pretty stable. Operating income kind of seems to be within the same range. Trying to move y'all out of the way so I can see.
Oh, sorry.
No, that's me. I got the thumbnails up so I can only see. Okay, good.
Yeah. Sorry, this is buggy.
No worries.
All right.
The earnings from continuing operations, like we had a spike in, was that 2018? Was it 2017, 2018, 2018? Things went down a little bit. And it's still above where it was prior to that. Trying to think of what are the other things that I looked at.
You looked at the earnings per share also?
Yeah, looks like I said, it was on an upward trend until the last couple of years, where it's, but it's still within range of what it's been over the last 5 years.
Yeah. Okay.
All right. Go to the balance sheet.
Yeah, man. I mean, once you get a general idea, man, this stuff is not very difficult to look at. You're right.
Right. So as long as the number, there's not like a huge shift in the numbers, it makes me dig a little bit deeper.
Yeah.
Look at looking at total assets, of course, it's pretty consistent with what was seen on the other pages, where up until a certain point we were going up and then had a little bit of a drop, but still within range.
And then we can get the bottom line answer down here in terms of the total equity.
Right.
And we see the bottom line. I mean, it don't look like Berkshire Hathaway, but
we still winning. Yeah, we still winning.
And that number was so crazy. I can't even get over that.
Yeah, man.
But yeah, the total equity has been going up consistently. So their assets are winning over their liabilities.
Right.
Yep.
And what I was encouraged by was the fact that you get dividends from.
Oh, so they pay out dividends, huh?
Yep. And based on the recent analysis, since we've been on, now is probably a good time to buy because it said it's kind of high mark for the dividend yield.
All right, so this is actually a really good point right here. This number right here, this payout ratio, is astronomical, and that's typically not a good thing. Why is it so?
That's scary.
That's scary. That's like astronomical. So it's like almost all their money went to paying out dividends. I don't know why that's so high. That's crazy.
What is it an indication of?
Right.
It's a bad thing. What does that tell me?
So in general, your payout ratio, this is real good. We have to do some more digging on that. I don't even know if we're gonna get the answer today. But in general, your payout ratio is usually, less than 20 or 30%, right? So that's basically of the money we got, revenue we got, how much of it are we giving back to the investors, right?
Mm-hmm.
So when you see a high number, it's usually with real estate investment trusts because they have rules and regulations that say at least 90% of their money has to go back to the investor.
Mm.
I've never seen a number like this before. I've never seen
It's almost telling you that it's like they're propping up the dividends, right? Because if you paid out that much, then what do they have to invest in as far as like new products and things like that? That's what's scary about it from this kind of sector.
Yeah, I mean,
there's no indication of them preparing to sell or anything like that, is it?
I don't know. I just say it's astronomical, but my next thing would be let me look at these peers, right?
Yeah.
To see if that same kind of crazy number plays out. So whoever this Lancaster, they also consumers, they also package foods. So these two are direct comparisons to one another. So I want to see what their dividend payout is. Yeah, that number's crazy. So I might have some concerns around that. And so maybe your homework is to do a little research on dividend payout ratio, right? Because like I said, in general, folks usually be 40% or less, and only in the case of like real estate trusts will you see something in the 90% range. I've never seen anything at 175%.
The other part that if you look at it is that their payout for the dividend was like 50 something cents a quarter, so $2 a year. So that's 175% of
what they got. Yeah.
There's some smoke and mirrors going on here somewhere.
And I think what's good to walk away with in this scenario, right, is like thus far what we were looking at, we saw gold. Like, there wasn't any red flag.
Yeah.
Right?
Right. Yeah.
You look at the 5-year, everything looks good. You looked at the balance sheet or whatever, all that looked good. We looked at the cash flow, that looked good. And it wasn't until we looked at this dividend that you mentioned that was like, wait a minute, what the hell is going on? So there might be an explanation for it. I don't know what it is, but I think it would be good for you. And maybe you could come back next week and share with us what is a typical payout ratio and why is this one so damn high? Because they've been paying out for 15 straight years and it's been growing, at a 9% rate for the last 5 years. But why are they paying? They're paying out more money than they're making. And you just wonder why.
Typing up my homework assignment.
I'm actually glad that came up. That was weird.
Cool.
Let's look at let's do the overview real quick. Maybe Maybe someone will tell us that if we're looking at the gross profit margin or something. Or maybe they got some, I don't know, or they're borrowing money to pay out. Like, I don't know.
Well, I Googled it. It says it's paying out more to the shareholders than the earnings coming in.
That's what I'm saying. Like, how do you?
Yeah, that's crazy.
How you pay out to your shareholders more than you making? And where's that money coming from?
I'm wondering if they're getting it from their parent company. If like I said, Johnson & Johnson are propping them up, I don't know, but I'm gonna look at their 10Q real quick and see if I can find it.
So we got a 28% gross profit margin,
and they missed earnings per share by 40 cents.
On top of that,
yeah, they beat on revenue, but they missed on earnings per share, that's because they're giving out that much money on the dividend.
They're giving out all their money.
Let's see.
Now, that percentage is current, right? That's not over time.
No, this is all current.
Because it looked like there was a jump, and maybe I read the graph wrong. Let me see. I can go back and look. Hold on 1 second.
This is also really interesting. So they got a lot of money. So they got $212 million in cash and only $68 million in debt. So that's good. I don't know, man. Maybe somebody was they were scared people were going to jump ship for some reason, or free cash flow of $43 million. I don't know. This is crazy.
That's actually not a lot, though. That's the problem.
Yeah, you gotta do some more digging on that. That's the only real red flag.
But y'all, you see what happened though. That one red flag since you start looking a little deeper and you start digging, you start seeing other things that don't really line up that well. Like I said, he paying out more than you can take it in. Then something's wrong.
Yeah,
your free cash
clearly
is pretty low.
And that's why we do fundamental analysis, guys. That's why you do it.
I don't do fundamental analysis. No.
That's why we do it.
And that's the benefit of having these conversations. Because when I look at it, I'm like, oh, that's what's up.
Right, because everything was there, right? It was like, all right, cool, I'm on it. And then, and you getting your payout, you probably be happy. And then you look up and all of a sudden they done burnt it down and renamed the company. So
it has to do something. It has to be something with Johnson & Johnson, the parent company, man, because
something.
I don't see how they have $1 billion in assets, $1 billion in assets, and 128 million in liabilities.
Yeah. So you gotta go find the answer, James.
Yep.
I wrote it down.
You just created a problem for yourself. But
yeah.
But when you find it, you gotta tell us how you found it.
Okay.
Right? Because I think what we would want to learn is what was the process that we would go through to answer some of those questions. Because that'll give us kind of the tools we need to be able to like figure out the payout ratio and all that.
Okay.
Yeah, so
goodwill from their parent company though.
Maybe, but I don't know.
That's part of their, normally that goes out. This is coming in. So
yeah.
That's part of their assets, but I don't want to belabor it. So
yeah.
We'll let James
go.
Thanks, James.
Yeah, thanks, James. So, no, but I think this is great actually, because I mean I've never seen anything like that before, and I'm really curious about why, and I'm glad you're going to look for it. I'm glad you're going to look for it. So let's just do one more. I don't want to bore you guys doing the same thing over and over and over again. I want to tell you a little story. So our stocks have been doing pretty well. Only thing I picked up this week, I'll commit to sharing with you guys so you can see that it's see that it's real and I'm not, faking the funk over here. Only thing I bought this week was I bought Twitter this week, and man, this is the worst computer ever.
And you say that, I mean, honestly, Twitter, I look at Twitter every day from a short-term perspective, and I would never play it.
Yeah, I'm gonna share with you guys what I thought. And again, I could be wrong, but I just want to share with you because I think it's a really interesting. I think it's an interesting story, which is why I wanted to share.
I think you may have something long term, though. I really do.
Well, that's what I'm shooting for.
Yeah.
But I thought it'd be a good like kind of teaching tool because it's a very, God dog it, it's a very that's what you get for getting two-factor authorization. Let's see.
The worst is when you have two-factor authentication, but then like your wife has the other code and you can't get in touch with her to get it. Yeah.
Right. Actually,
You might just need a registry mechanic.
you're speaking Spanish, brothers. What does that mean?
Oh, it's a program, an app that you can use to clean up your computer file.
Yeah, she needs something on here because it's crazy. All right,
Run Malwarebytes on it. Look at I'll send it to you, Omar. But look at the program Malwarebytes. Run that on there. You can clean out whatever underlying stuff might be there.
Malwarebytes, BY, BI.
BY.
Okay.
You might have to run it twice, but run it on there initially. It should show you a bunch of stuff. Clean it, reboot it, run it again.
Okay.
It works on the
So here's what's going on in my account this week. 10% gain or 11% gain. $6,200 that I've made.
Last week that was at 5,000. I'm just bringing it up.
Okay. I don't know what it was, but here we are.
John Gotti over there. I don't know what it was. Unless you got this watch, you can't even beef with me, son.
And then, so this week, what I did, I think this is how I'm gonna find it. So I bought some more Facebook because y'all know how I feel about Facebook. I bought some more Facebook. I also bought Twitter, and I bought Twitter on a what do you call it? Trailing stop. I bought Twitter on a trailing stop. And then here's, guys, I want to show you, I got paid. I got paid my dividend on my Realty Corp. I got paid $6.99. Didn't have to go to work. I transferred $500 in, I think probably to buy that Twitter. Yeah, I transferred $500 to buy Twitter. Transferred another $2,200 in to buy that Facebook. And yeah, that all happened this week. Oh, I bought some more Twitter before that. So I bought Twitter here, and I bought more Twitter here. I paid a little bit more for it this time than last time. And I bought this store, Realty Corp, as well. So I share that to say, like, I wanted to just prove to you I'm not making stuff up. I really believe in my analysis. And so I just wanted to show you why, or rationalize with you why I did what I did, and we could talk about it. You know what I mean? So this ain't no fake story. It's a real story because y'all saw that I actually bought it in like real life. You know what I mean? And so what I did was started off from the beginning like everybody else, and what you're going to get from the very beginning is a very interesting story. And I need to do that malware thing immediately. What you're going to do, so if I go, I'm going to actually go max on here because Twitter ain't been around that long. But here's what you see. So it's the IPO somewhere about here, 2013, right? They came out the gate. Lord of mercy. They came out the gate. Let's do 10. Okay, they came out the gate at $43, right? And then people went nuts, went crazy. It shot all the way up to 69, right? Then people was like, nah, you pay it's way too much. And then it dropped down like 30 something. And then it's been doing this U-shaped thing right here. And kind of like some kind of consolidation kind of thing here. And of course, COVID-19 hit right here, right? So when it first came out, it was hot. And then people jumped on the train. And then it all went down. And I know why it went down because I've done the analysis. So I'm going to show you. And then I'll also tell you why I thought it was a good idea. So long term, because this is a growth stock. I'm not getting no dividends off of this. My investment in it is the hopes that it's going to bubble at some point. So what you're going to see, let me scroll this up real quick. What you're going to see is that the revenue over the last 5 years has been creeping up a little bit, and the profit has been creeping up a little bit. Now here's what's interesting. It's operating income. They were running negative. They were running a negative in 2015 and running negative in 2016, right? Things were not good, and the stock price at the time will show it, right? Then 2017 was a little bit of a pivot, and now look at the trend that's happening after that. So to me, this tells me they found a way to start making some money.
So the parentheses mean negative?
That means negative.
Okay.
Right? That means negative. But now the trend is, it's only 3 years, but that trend is starting to change, right? Then when we go to earnings from continuing operations, again, negative, negative, negative. And now the trend is changing over the last 2 years, right? Net income, negative, negative, negative. But now we're starting to see a change, right? You see the theme here. Earnings per share, negative 79 cents, negative 65. So those early investors got hosed, right? Because that price dipped so much. Negative, negative, negative. But look here, things done changed, right? So what that is telling me is that Twitter, over the last couple of years, has found a way to make some money. They found a way to monetize that they hadn't before, right? And their stock price right now is less than it was when it first came out. It's certainly less than what it was when people jumped on it. And I just want to keep on looking a little bit, right? So I look at these current assets versus the liabilities. We're going to go down here to the stockholders' equity, and now I'm looking at $4 billion, 4.3. Then I'm going to 4.6, 5 billion, 6.8 billion, 8.7 billion. So even though all that other stuff, remember, was negative, there was still equity. They would still have more assets than they had liabilities. You understand what I'm saying? They still got more assets than they have liabilities, right? And also, what I'm seeing here in these retained earnings is they got a little ray of sunshine right here in terms of like holding on to some of their money, right? So I looked at that. Then I went to the cash flow. I I went to the cash flow. Cash from operations. I mean, we're talking about from 383 million to 1.3 billion in 5 years. Right?
Trump did that.
I don't care who did it.
No, look, I think he made Twitter very popular. Look at the timeline.
You might
Yeah.
might be right. Right? And again, you know, going down here and like that net change in cash, which takes all these things into consideration, we was in the negative, and then we started moving positively. Something happened here, which probably means they did some crazy investing or something in that year. But the trailing 12 months is looking good in terms of their cash holdings versus where they were. And their free cash flow, 258,738,661. They're bringing in, they're figuring out this money since they're figuring out how to monetize. And to be honest with you, I don't think they really figured it out yet. I think they're in the process of figuring it out. I don't think they figured it out yet, right? So then again, looking at the profitability, the gross profit margin is 66%. I love that. You know, having a return on equity of 15%, I love that. And I'm looking at their revenue and then what they got after they pay their bills. They're bringing in $3.4 billion, and they got $1.2 billion left after that, right? Then I'm loving the fact that how much cash they're holding. They're holding $7.6 billion. If for some reason they had to pay all their debts off, they could pay all their debts off and still have $3 billion left after they paid their debts. And so for me, this looked like, I mean, we can go here at the peers. And then when I'm looking at the peers here, I cared less about these things because I know they are what they are. But I really just wanted to get these larger snapshots of the revenue growth. And they got a revenue growth of 10% right now. Moving forward, it's going to still looking at about 10%. Gross profit margin, you know, Facebook is king, but they got a better gross. They're making more money than Netflix on the profit margin side, right? Which was good to me because I feel like Netflix is everywhere. And they're, I'm looking at this thing Godard talked about earlier. $750,000 per employee for revenue. That's more than Johnson & Johnson, as we just saw.
I would say, Omar, they're probably going to go up with that too because, you know, they just made the declaration that their employees can work from home forever. So their overhead is probably going to go down.
Right. So I'm looking at that, and then I'm looking at their 5-year performance. And guess what? It hasn't been good. We already know that. It's been terrible. But I'm looking on the other side of it based upon what I see fundamentally right now. I saw a shift. And I'm hoping, I don't know, but I'm hoping that I'm going to benefit long term. I don't know it, but to me, based upon my analysis, my fundamental analysis, I can say, you know what? I think this is a worthwhile bet. Let me find out. So what are y'all's thoughts about that?
I mean, I think when you break it down like that, I think it sounds good. You know, I mean, combine, so you having that aspect of it, and then, you know, like for me, just looking at what's been happening with Twitter and Trump over the last couple of years and seeing where it's going. That's the main thing that news media uses to communicate quickly. I mean, the way I see it, even without that analysis, it's gotta go up or at least maintain. I don't see it going down because Twitter's not going anywhere unless something bigger comes out where people can consume media that fast. You know, Twitter is instant news. So I mean, I think what you said makes sense.
And like I said, I don't think that they have really figured out how to monetize themselves yet. I don't even really use Twitter, right? And so I don't know if they figured out how to monetize, but I know from what I see that they figured out something that they hadn't figured out before.
Yeah, I mean, I think unless they do something stupid, you know, with this new money, like a stupid acquisition or something like that, I mean, I think it makes perfect sense.
Other thoughts?
And of course, this is in the world of finance, uncertainty, risk is uncertainty. That's the definition. We typically think risk is a threat physically, but in finance, it's uncertainty. There's a lot of uncertainty here. So this would definitely be something I would think that's good to invest in for a nice little second or third base hit, you know, maybe even home run. But it would comprise a smaller portion of my portfolio than Facebook.
Yeah, and I think like so for me, and I think that's a good point, Cogs, in terms of like the diversification idea.
Yeah.
Like I think you got to take some risks sometimes, a calculated risk, right? But I think you got to take some risks sometimes, but you also got to cover that with like smarter, more sound things. So you know, if you peep, like I got Coca-Cola, that's like sound. You know what I'm saying? I got J.P. Morgan. Well, although there's questions about banks right now, but you know, I got some sound stuff in there. And then even for the stuff that's not sound, I'm like, all right, fine. Here's my ETFs that cover everything, right? So I got those. So I put myself in a position to be able to take some risk because I know I have the backup of the safety nets with the ETFs and some of those other stocks that are much safer. Other thoughts on what we looked at?
I have a quick question. So I'm sorry, most noble. Go ahead.
Go ahead, Brad. You good?
No. I'm just the monitoring of your portfolio. You look at this every day, multiple times.
I look at it just because it's fun, but I wouldn't encourage. Like I look at it because I know that I'm not selling nothing. I don't look at it to be like, oh my God, what's happening right now? Should I sell something?
Gotcha. Okay. All right.
But I look at it because it's fun to watch. Like, ooh, man, I'm winning on this, right? And so I look at it from that perspective, but I don't look at it from a perspective of like, oh man, it's just because I got, you know, my Disney stock went all the way down at one point and then it bounced back up. I'm losing on my Boeing stock right now. I haven't made any money on that at all the entire time I've had it, but I'm not selling it. So, you know, so I look at it from that perspective. You said you had a question, James?
Yeah, basic question, and it might sound like a dumb question, but I'll ask it anyway. Can you ever lose more than your initial investment?
I'm sorry, you caught out.
Can you ever lose more than your initial investment if your stock tanks?
Oh, I can answer that.
Go ahead.
Yeah. So, in a way, yes. In a way, no. I think I know what you're thinking. So, say you bought a stock at $30, right? And then you keep it for 20 years, and then next thing you know, you have $3,000 from that little 30.
Right.
Now you can lose 1,000 of that, right? But the overall profit loss from that angle, you haven't lost any money. You still profit. So it depends on the angle you look at.
No, there's in some ways, like if a company goes bankrupt first, I guess us common shareholders will get last in line in terms of legal proceedings. So when they got to divest and sell like the bookshelves and all the infrastructure, those Class A holders or Class B holders, they get their money first.
Preferred stockholders.
Yeah. and then us, common shareholders, we will get something last if there's something left. So that's kind of the only way that I know you could lose out on your initial $30 investment. It could just go away, poof.
Yeah, so there's that worst case scenario, right, where like company goes belly up and you lose money that way. But the angle that I want to take it at, and I want to share with you, is like from my own 401k or 403b, right? In January, I was winning, and then in March when I looked, I lost over $100,000. But what I really want you to think about is that
Me too.
you haven't lost anything unless you've sold it.
I said,
Right.
Oh, man, you don't lose.
There is no such thing as a loss, and there's no such thing as a gain.
Yeah.
Like unless you've sold it, you
It's all
haven't.
monopoly money.
You haven't lost anything.
It's
Right.
that's why it's called unrealized gains or unrealized losses, man. Because, like I said, until you do something about it, it's paper.
Right.
Unless you get that alternative minimum tax.
If you get that, you got something else going on.
Yeah, I do.
Yeah, you probably got some IPO crap going on or something over there, man.
Yeah, Godot. See, we got some smart brothers in the EPI, man. We need. I know this is a segue, but stuff like this, I know we haven't done a lot of this in terms of just sharing the knowledge that we have on anything. I mean, this is stock stuff, but I'm just about anything that we've done. We need to do more of this.
Yeah. So that's a good segue. So good second week, man, and I think I'm proud of all y'all for showing up again. You know what I mean? It's the same contingent. Spriggs hit me up, said he really wanted to be here, but he had something he had to do. He was hoping it was going to be recorded. And TJ hit me up too, said that he wanted to come through. And so I really just want to say that, like, I think these conversations are fruitful because I learned something today. And in a second, I'm going to have everybody share something that they learned that was new today. And then I'll give you your homework assignment after that. So let's start with you, Mickey. What'd you learn today that you didn't know last week?
Well, I mean, even the stuff that we went over today that we did go over last week, it's still just kind of like absorbing everything. You know, that last analysis of Twitter that you just did and the way you went through it, you know, that was pretty helpful for me as I get ready to buy a couple things here in the next week or so. You know what I mean? So just overall, and then the stock that I think was James that pulled up, you know, and just looking at that like 175%, but that the payout dividend portion and how that's not necessarily a great thing. So now I'm going to go back and look into stuff like that to try to figure out how to spot that kind of thing. You know what I mean? So I guess if I want to say what I learned, it's just kind of another way to be aware of kind of what the stock is doing.
Oops. All right. Call on somebody.
Number, cause.
Yeah. No. So the one thing I did glean from definitely is when we were looking at that one stock, I forgot what it was, JJ or not Johnson and Johnson. It was another one, but I noticed the stock had gone down, and then it looked like, oh look, there's a potential for it to come back up. But we dug into the financials, and we saw maybe there's a potential and maybe there's not, you know. And also it compares with Twitter, where Twitter may seem like a bad stock just looking at the chart. It looks, oh man, look, there's no constant growth. There's not a steep trend. Oh, leave it alone. But you got to dig deeper and go, oh wow, look at that. There's a lot of potential here. It's like a powder keg. All you need is a match. They just need to figure out monetization and expand, because you never know. Twitter could be the next, I mean, who knows? Like they could come up with a way to add shopping or some sort of product consumption, or maybe a streaming service. You know, maybe that's where a lot of gamers could go to watch, you know, the Call of Duty contest or whatever, championship or whatever. So I saw that. You can't just start with the stock chart and go and dismiss it at that step. You got to dig a little deeper, just whoop, whoop, hit all the points and keep going.
Young Rob, you've been here the whole time, unlike last time. So now you in the class. What'd you pick up today?
I learned about how the dividend yield can tell you kind of like when a good time to enter could possibly be. Because if the dividend yield is up, that means the stock price is likely going down. And just like the overall analysis of the company, because I don't really know all about that stuff like that. So just learning how to dig into like what a company's actually doing through the numbers is what I pretty much do.
Nice. Cool. Jason, what you got?
I was going to say the same thing about the entries on the dividend yield. So I'll talk another thing I learned is about tech stocks, growth stocks. What's the difference in those definitions? And, you're really looking for the long-term home run on those and not necessarily the daily grind.
Yeah, you can do either one or both.
Yeah.
Call on somebody.
Brian.
I learned as far as like on the same note of the payout ratio, that it shouldn't be more than an average of 55%. It shouldn't be any more than that. And anything above that, it's like an anomaly, I guess I would say. And I just built on it.
Cope?
I'll say that's that line item shareholders equity. Yeah, because I kept going back and forth with my analysis. Assets over liabilities, you got to keep scrolling up and down, up and down. I was like, God dang it, you got to be a better way. But then, you showed me that. I was like, that's where I need to be.
Yeah.
Hey, bros, I hate to leave early, but I have to take care of something. So it was good. I appreciate y'all.
All right, brother.
All right, Cox.
Did you have something that you wanted to add or throw in there?
Who, me?
No, I said Godard.
Oh, Godard.
I'll give a piece to Cogs.
Peace to Cogs. All right, bro.
All right, peace.
Yeah, no, I did have, I was thinking about something a second ago. I lost it just that fast, man. Not good.
Maybe you are getting a little older there, brother. As we all are.
No, hey, brother. There was something about the yield, and because I know what dividend yield is, but it was something about the yield that was interesting to me. I'll come back to it in a second, man.
Okay. And Mickey, you went, right? Yeah. Well, I learned about malware bytes.
Mickey, I need that link, Mickey.
Which I'll be putting to immediately.
Gotcha.
But yeah, no, that thing that Godard shared in terms of like the money, the revenue money for the employees.
That was me. That's what I wanted to do. That right there, I was like, yeah. Especially being an educator, I feel like I'm not viewed like that per se. I'm already a indentured servant, so it's like, it ain't no money on me. I'm just here, just giving to the people. Yeah. But I was like, yeah, 700 something. Those numbers were just wow. So I was stuck on that. After he said that, I was like, wow.
Yeah. And I think for me, it was just like, while I was talking it out, I was just like, this is an indication of how well a company is doing. When they bring somebody in, they're not looking at them as like, they're looking at it from a monetary perspective. Like, how much are you worth?
Yep.
And you're worth $685,000 to me. And that's why, right?
That's why you're easy to get rid of if you don't perform.
Right. So, man, that was clear. And that was probably the biggest learning for me. Any final thoughts or final offerings before I give you the assignments?
I think the one thing that's clear to me, above and beyond, because I know you and Godard always go back and forth about the fundamental versus the technical analysis. But I think I learned a fundamental lesson tonight, even beyond the technical analysis that we may have done and included with the fundamental analysis, that it's great to have mentors for questions that you like, for stuff that you don't understand. So I wouldn't have known when I was looking at the dividend yield that the 175 was something to kind of be like, hold on, wait a minute. Looking at it, being a newbie, I'm like, oh, that's good. But the fact that you have people in the room who have more knowledge can give you an insight. It's like, well, number might be big, but that might be a problem. So, it's always good from a fundamental perspective to be able to have mentors where you can bounce those types of questions off.
Yeah. Yeah.
Yeah.
Yeah.
So let's
Go
talk,
ahead.
like I said, you guys know I would say I'm not a fundamental guy, right? I'm not a fundamental analysis guy. Can I do it? Yes. But my style is a little bit different, right? My style is just more, I like a little bit more action, right? But I think what I learned is I can actually see how I could have some fun on the fundamental side of the house. Because I look at stock charts all day long, right? That's what I mean. I'm at work, I got my other computer right here, I got stock charts up. I'm talking to you guys right now, I got my charts up, right? So I'm always looking at charts. And so it's actually pretty easy for me to make that transition. And so I think what I did learn is that I probably will put a couple of dollars somewhere and on a more of a long term, not 401k, not something I just kind of put and look at every quarter, right? Because you can make money either way. The other part I learned is the fact that when you diversify your portfolio between a dividend stock and more of a growth stock, just kind of what are you looking to get out of your returns, all right? Because you can actually invest in a dividend stock and it doesn't do anything. Right? I mean, it just be simple.
Yeah.
Because in my mind, the only way, if I buy a stock, the only way that I look at it as making money is if the stock goes up, right? Because if the stock goes down, I'm losing money in theory, right, on paper. But if it goes up, then I'm making money. But the dividend side is actually a little more interesting to me because at least I know I'm guaranteed, quote unquote, some income that I can reinvest probably at a lower price than what I got it for. So
yeah.
And
if I were to add on to that, one of the funnest things that's been happening for me was like I've had this class with my daughter. She's 18 years old, right? And I've been giving her. I said, here, look, I'm gonna give you money every month. You go invest. We could talk about it, but I want her to learn the fundamental analysis because she's in the position to have real long-term investment opportunity, right? And so I think, to add on to that is just like your opportunity, like, just great having your son sitting here listening, and your daughter's right behind to be able to just say like, hey, I might not be into fundamental analysis that much right now, but I'm kind of getting into it. I'm going to give this off to you. And if you want to go do investments with fundamental analysis, you can. If you want to do options with the technical analysis, you can. If you want to take both of those and do Forex, you can. If you want to do all three, you can. So I think like if we keep this up, my goal is for us to grow because I do think that we have a lot of intelligence in EPI. And it makes no sense for us to hold it and not share it. And this is food for the soul for me. I think we started off with how's your week going? My week was terrible. I've had a horrible week, just related to my job and my hating my job and all that. Chest been tight, stress and all that. And I actually feel no stress right now, right? So it's just been real beneficial and like food for the soul and like a time that I look forward to. When I did it last week, I didn't know it was going to be another week. But whoever was, Dom or whoever was like, what's the homework? I was like, oh, shit. Okay, so we can do this. Y'all want to do this again? Mm-hmm. And part of me was sitting there like, are they really going to come? And then, y'all being back here tells me we can start moving in the right direction. So here's your homework for next week. One is recurring homework. Always go back to Facebook and drop your line. But I'm going to put a little pressure on you. For next week, bring somebody with you. LB, big brother, undergrad, whoever it is, bring somebody with you next week. Don't come empty-handed, right? Bring somebody with you. I dropped a video in the chat. That video is from the Motley Fool, which is a really good website in general for investing and stuff like that. But they talk about, it's a really good video, so watch the whole thing. But they talk about dividends. But then they talk about like the pluses and minuses. Like, it's a really, really, really good video. So I knew the theme for today was going to be like, dividends. And so that's why I dropped that video in there. I'll also be putting it on the Facebook page. But watch that video so we can talk about it a little bit next week. And, while you at it, sit your wife down or whatever, or your girlfriend or whatever, and say, hey, come watch this video with me. You know what I'm saying? So that they can get a little something out of it. So go to the Facebook page like you did before. Throw your information, like how you felt about what you learned today. Bring somebody next time, and then watch that video. And then in terms of like the stock, there's a couple of them that we didn't get to today. Maybe we can look at some of those next week, or, maybe there's something that you might look at this week and be like, oh, I want to talk about that, or I'm curious about that. And I'm certainly down with doing that, for sure.
Yeah, you said the perfect thing, man. Bring somebody with you, because here's what happens, right? So, O is a great teacher because he's a teacher. Like when I do this for options, it's like I'm expecting people to actually know some things, and we go a little faster. But this is actually a perfect speed, especially if you're starting out. And so the other thing though, that'll be our third week in, and so now we're starting to accelerate a little bit more, right? So you guys know how to do an analysis. You guys know how to do these things. So if somebody's going to come along, they need to come now. So if you bring somebody along, make sure you bring somebody along who actually their mindset is ready for this, not just let me drag you in.
Yeah. And if you want some extra credit, before you bring them in, do what I did. Do what we've been doing for the last 2 weeks. Give them a little, like, hey man, I don't know everything, but let me just show you a little something, right? So that they ain't coming in butt naked. You know what I mean?
Look at these numbers. Look at these bold numbers. You know what I mean? That's important.
y'all crazy. The chat's hilarious. So yeah, bros. Once again, I appreciate it. Drop something on Facebook. Bring somebody next time, and definitely check out that video because, like I said, it's really good.
Yeah, I put them in that chat in the Facebook page. I think it was Facebook. I'm not sure, but you guys, it's a really cool site. It's called 11 Graphs.
Yes.
They're actually building out some kind of website to it, but it's actually on Instagram and all.
Go follow them on Instagram.
Yeah,
what's it called again? Say it again.
11 Graphs. 11 Graphs. But what it does,
it's really dope on Instagram.
Yeah, if you look at it, what it does, like it'll tell you, like, hey, if you invested $1,000 in CVS at this price, here's what your annual dividend would be, or here's how you compare these two or through 4 companies, and it kind of gives like little medals, like which one's the best. And so it's just a really cool way. Like if you had $1,000 to invest, here's how you could break out a portfolio to buy certain shares. So it's mostly infographic type stuff, so it's actually easy to consume, but it's actually a really cool. It's interesting to me. I actually look at it more than I thought I would.
And what I like about it too is that everything they put out are not winners.
Yeah,
they aren't all good. So it's not stock advice, right? It's just like, what if you did this? Here's what will come out.
Yep.
And so I like it too. You showed it to me as a matter of fact.
Yeah. So like if you had if you put $1,000 in Starbucks, your dividend is only $22 a year, compared to like even Walmart, you only get $17 a year at Walmart. But like Pfizer, you get $41 a year. So it kind of gives you that perspective of just like, oh, there's some things I might want to look at a little differently. So it's in the chat. I say I would check it out. And it's not 11graphs.com. Do it on Instagram because their website's not up yet. But
yeah, do it on Instagram. It's good on Instagram.
Yeah, they got a Facebook, Twitter, all that stuff. But the Instagram one is pretty cool.
Yeah, I would like to say if for the brothers that haven't started investing yet, when you get that first dividend, it's gonna be like crack, man. It might not seem like a lot, but I mean, just a possibility. I mean, you get that. I showed his was like $6 or $7.
Yeah.
I mean, that's just one stock. I mean, you got quarterly and monthly dividends. That stuff adds up. And you know, you see that hit your portfolio, you're like, man, I can get this and I ain't do nothing.
I didn't do nothing. And like I said, with that $6.90 whatever cents,
That get reinvested.
That's reinvested. I didn't get a check for that. That went back into that stock. So I now actually got a little bit more of that stock than I had before, and I didn't do nothing.
None.
That was when you were REITs, right?
Yep, that was one of the REITs.
That was the REITs.
That's why I was so high. Yeah.
Yeah, that's what's yeah. But AT&T, I mean, that, you know, we talked about that today. That's not gonna, I mean, it's down now, so it's good to get in. I think it maxes out at like 45 or so, something like that. For AT&T, is at like 30 something. But when those dividends hit every quarter, I mean, you're getting, you know, $5 every quarter or so, depending on how much you got in. But
And that's how you can use that dividend yield that we talked about earlier to be able to determine. And you're going to see, look at the dividend yield, like if you wanted to buy it, it's a good time to buy it.
Yeah.
You know, and you know you're going to get the money because they're one of them aristocrats. They've been doing it forever.
They've been doing it. They ain't going nowhere.
I need to go through and familiarize myself with Seeking Alpha a little better. Because, I mean, moving into my new place, I've been on hotspot. So I've had consistent internet and Wi-Fi for about 2 days. So, like...
I tell you, Seeking Alpha is really good. It's terrible on the cell phone. I mean, you know, you mentioned that earlier, James, but it's not good on cell phone. It's good on the computer.
I learned that too this morning because there's an app. There's an app too.
Yeah,
that's terrible.
If you wanted to use your phone, Yahoo Finance is pretty good.
Yeah, I have that too.
All right, bros. Well, thanks again, man, and go do your homework. You know, if you want to knock out that Facebook joint, just as soon as you close the door or leave the room, just go do it real quick.
Yeah, so somebody do that for me too, because y'all, I don't do the Facebook, man.
Hey, Ronnie.
Ban the book.
Bro, you've been banning the book for a decade.
Yeah.
Yeah,
man. Nate Barfield's up there now, man. Come on, bro. You gotta go.
Man. Can't do it, man.
You guys know, but seriously, this is what happens after you like start doing this for a while. Everything you look at is you're gonna start looking at it in reference of like what it looks like from a stock perspective.
Wow.
Right? So I go look at, I'm gonna buy this Jordans. Okay, well, that's $300-something Nike stock.
Bro, I was looking at Nike today.
You could buy a share of Nike for less than a pair of Jordans.
Like 3 shares for less than a pair of Jordans.
Something to think about, man.
So you guys
for real.
start looking at stuff.
Yeah.
I was looking at Nike, Under Armour, all of that.
Yeah. Yeah, I don't drink, but I'll invest in a liquor company in a minute if it's the right one.
That money, shoot.
Right. Nobody gonna stop drinking no time soon.
Exactly.
Especially during COVID times.
Hey, that store is essential.
Yeah, the liquor store ain't closed.
Liquor store ain't closed. That's essential business.
I have another quick question. So, is there like a list, or where do you find the stocks that have the dividends, or that, you know, is there? You just got to search through each.
You could, but I could drop it real quick, huh, baby? Okay, well, hold on. I'm using it right now. Yeah, hold on, baby.
How many minutes?
I don't know how many minutes. A few minutes.
Sound like my kids. How many minutes?
His job is never done.
That aristocrat list that I talked to you about earlier, I'm about to put in the chat right now. That's the starting place. So that'll give you a whole list of like I said, the aristocrats. That's a starting spot. But again, most stocks are in that dividend area unless they're growth. And you're not gonna see them there.
Yeah.
But you can start with that. You can start with that list because, like I said, that's the aristocrat list. Why is this back door open, baby?
Yeah, we're not going to do investing after dark this week either.
There you go.
Yeah, I was a part of the investing after dark. I learned something from that.
Yeah, that's the accelerate. We say that was what, episode 5 or something? Episode 6?
Yeah, that was the AP course, and I was still in middle school.
Yeah, As long as you learn something, brother.
Oh yeah, I got something out of it though for sure.
All right, y'all know what I'm dealing with over here right now with this computer. So.
All right.
All right,
All right,
Y'all
dog.
easy.
Easy.
See y'all next week,
All right.
man.
All right.
How to get this recording up to you?
Yeah, I don't know whether to compress it or whatever, but we'll figure it out.
Yeah, I can upload it to somewhere, but I don't know where we're gonna put it.
Yeah, I know.
Do the you could do I don't know if you have a private YouTube, but like I have I did the EPI AA domain. Like I got a Gmail account with that. If you wanna, once you get it compressed, if you wanna shoot it over Dropbox, I can send you a Dropbox folder, and I can just hook it to that Gmail account, and make it private.
Yeah, go ahead and do that, man.
Okay.
All right.
I'll see. Yeah, on Facebook, Godard, send me a email address for you, and I can just send you a Dropbox folder. And you can put it in there.
All right, I got you.
And I'll take it from there.
All right, man.
All right.